taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to Total Money Management. I'm back with Tom and Steve. We're running through another week that was September 30 to October the 4th. And this week, guess what? We're going to talk about China.
It's just 30 minutes of Steve talking about China.
China, BYD, Doritos.
That's it. It's all China. Whatever you think, it's just China.
Well, I mean, it's
pirates and politics.
They've had an absolutely astronomical run at their ETF in the last week or so.
30% in the last 2 weeks or something.
The old told you so.
Well, I mean, they've got a really cheap cape. I'm not sure what it looks like now after a 30%.
Well, it's probably gone up a bit, but yeah.
And the funny thing is, I was talking about it to a few of the lads at work last week. So, maybe check out China, like they're cheap, blah, blah, blah. And then I've had them running into the office thinking I'm a genius. Didn't predict it.
Nostradamus.
Not financial advice.
Exactly, NFA.
Oh, dear.
So we'll talk about China, the boom, a bit of credit growth, what a recession does to your potential returns, a car crash, and trade ahoy.
Yeah, couldn't think of many snappy titles.
That's all right. You can't be a genius every week.
Well, that's true.
We've only got 4 Chinas in the title now.
So the Chinese government indicated last week and this week actually that it was about to make some changes to its banking rules, which would attempt to boost some lending because they've had an atrocious last few years. And again, it's important, even after this 20-odd% run, that we keep a long-term perspective because they're still cheap and, more importantly, take a bit of profit off the table, I think.
It's usually part of a good...
Rebalance.
Yeah, well, it's a good idea. You know, like this is the hard part of investing, right, is rebalancing. If you're winning, you feel like you should leave it. If you're losing, you feel like you should leave it, right? It's just the way it works, and that's why it's important to have a systematic approach. So you can just say, I know I'm up 30%, good, I'm going to sell some. I know I'm down 30%, good, I'm going to buy some.
Well, if you rebalance properly, you're still going to have heaps of stock. So it's kind of liberating going, well, I've taken some. So I feel like I tick that box, but I'm still in it. If it's going to keep running.
Yeah. Well, that's what we also talked about, Tom, with that's one of the advantages over property, right? I'm just saying, if you can't rebalance property, you got to sell the whole property and you got to take all the profit in one hit.
Yeah, you can't sell the mailbox.
Right? You can't sell a bit and say, well, I've taken a bit, but I'm still good for it.
Yeah.
Right?
Well, when you buy matters.
Yeah. I don't know about you guys. It was good to see the Well 2 or Well 1 members having a bit of a win on China as well.
Yeah,
in the chat.
Yeah, well, it's just, look, Walter Slosh, an old American guy, lived to about 102, I think. He said, they sort of said, how do you buy stocks, Walter? And he said, you just buy cheap and hope for something good to happen. Right. And generally that's the way it works. Like last week we talked about Buffett and investor psychology and that sort of stuff. And it's exactly the same in stocks. If you buy something, why did China go up 30 or 40%? Because everybody looked at China this year and went, oh man, you don't want to be in China. Oh, it's ugly. Right? The government comes out and says, oh, look, we're going to spend some money. Bingo. 20 or 30%. And it's because when it's at the bottom, it's really hard to be a contrarian investor, but it really makes money because when you look at it, China's cheap, you're looking at the price. If I said to you, oh, Tom, I've got an investment, it'll be probably compound 11% per year, you'd be going, oh, man, I'll get into that. But if I said to you, oh, it's China, you'd probably, oh, it's Steve. I'm not sure about that, mate.
It's down 30% in the last few years.
Yeah. Isn't China terrible? Isn't the property market falling? All that sort of stuff.
Yeah, while Steve's sitting there licking his lips. But that's the important point, right? Like, price. We go on about price and value all the time. But that's not applicable with specky miners. For example, like just because a stock's 1 cent a share, that doesn't necessarily mean it's cheap or, valued efficiently. Yeah. Usually if you buy something good, like a good big company, it's been around for a long time, that isn't going anywhere, and it's cheap,
Yeah,
then
steady
eventually
dividend.
something
Yeah,
will happen.
absolutely.
Unless it's something like Luke Oil,
Yep. But you
or
get-
something in Russia where
But you get those.
all of a sudden you lose.
Right? You get those. And it's the same with, Argentina or places like that, right? And that's where you've got to look at sovereign risk and say, okay, is there a risk, right? And that's where, again, with Russia, you wake up one day and Putin says, oh, by the way, we're going to invade Ukraine, right? Now, if you remember back, Luke Oil shares basically lost all its value in 2 days. Right, and that's where you look at it and say, "Oh, it could have been quicker." No, that's the way markets work is it's the unexpected event that gets you, right? So when you look at China and you go, "Oh, China's miserable and its property market's awful, and the stocks are struggling, and they're going to put tariffs on Chinese vehicles. This is really bad." What's the unexpected event? The government comes out and says, listen, we're going to throw a shitload of money at the economy. And it goes, beauty, and they all rush in, right? That's if I said to you in January 1, Tom, September they're going to come in and they're going to stimulate the economy, you should really buy lots of China now because I reckon it's going to go up. You'd be going, nah, I can't see that happening.
Yeah, but you probably had a bunch of people shorting China too.
Absolutely.
Going, it's going to keep going down.
Oh, they've been
Well,
liquidated.
part of the rise is actually what they call short covering.
Yeah.
Right.
Where they have to buy shares to get out of their position.
Yeah, well, they have to buy shares if they're short 100 stocks and the market goes up 30%, they're going, man, I'm getting killed. So what do? They buy 100 stocks to make it neutral. So from there, if it goes up 20, they're down 20 on their short position, but they're up 20 on their long position. So it cancels it out, right?
Yeah, but you can lose way more shorting than
Oh, yeah.
We've been
way
there.
more.
Oh, Tuesday. Well, actually, let's finish on quickly on that one. Those that have had a big sugar hit will expect it to do another 25% in the next couple of months, and the likelihood of that happening is pretty low.
Yeah, well, it's,
Is it?
Well, 25% in 2 weeks is a bit of a
What do I buy then? Since you know.
You take profit and weigh.
sound advice. It
Tuesday.
doesn't. Isn't it funny? Everybody does the same thing. Everybody thinks they can bloody well time it to the Wednesday at 4 o'clock when it peaked, and then I sold out at the peak, and now it's going down. I'm a genius. It's like, mate, you got zero chance of doing that, right? You made money. Yep, good. Well, just take some off the table. That's all you got to do. It's not as if you're saying, Steve, if I don't get this right, it's death. It's like, well, you got another 30 years to invest. Don't worry about it. Just keep making money. Right? How do you make money? By not losing money. I've made 20% in 2 weeks. Good, we'll take some off the table. That's the whole idea, right? It's just people trying to time the market to perfection without saying, yeah, but if you made 20% every year, would you take some? Yeah, okay, well, don't worry about it. Every year just prune your portfolio, and then when it falls, put some more in. Right, and that's why we use CAPE and those sorts of things to give us an indicator about where you should be putting your money and in what size asset allocation. Right,
Well, those guys are just liquidity for the rest of us.
I just want. Did you read that in a book, mate?
Yeah. For the Buffets. All right, back onshore. Tuesday, private debt's crept up a little bit, 0.5%. Nothing really new here. Back in Australia.
Albo's got to spend some money.
Yeah. Do you think he will?
Well, if the polling's anything to go by, he probably should. I think Chalmers came out this week or last week. It might have been this week. And they're boasting even more about getting a surplus.
I thought they were going into a deficit next year.
Well, they are. They are 1.5%, which is not, it's sort of okay, but it's not a lot.
No.
And that's why I keep saying, I know everybody, the economists are going, they're spending lots of money. Well, sorry, they're not spending lots of money. If you think Albo spending 1% deficit is a lot of money, what do you think about Joe Biden spending 6.5% to 7%? They must be having a heart attack. But the proof's in the pudding. Look at the results. They're going gangbusters over here, and over here we're worried about trying to keep the economy afloat with an economic growth rate of less than 1.
Because they're trying to curb inflation. Is that part of it?
Well, that's what they reckon.
Yeah.
Well, don't get me started, Jacob.
The Aussie dollar's already monopoly money compared to everywhere else. So.
Righto. What else have we got? One good recession. There you go. I'm going to take that. That was my quote.
Was it?
Yeah.
You need to trademark it.
Well,
I can't wait for. I know this is an unpopular opinion, but I can't wait for a bloody recession.
well,
You say that till you lose your job.
Yeah.
Yeah, well, there's a bit of truth in that, Tom. But my point being, if you look at that chart, mate, what are you doing on the charts?
We got charts.
He's way
miles
behind.
off.
We might have to move you on.
Lucky
Jacob.
we've got Dan.
That's all right.
Yeah. Yep. Cue you, Dan. Righto. Yeah, if you look at that chart, the reason why I say that is the 1982 to 2000 bull market in the US was about 16% compound per year, right? So that means you basically quadrupled your money. Mm-hmm. Okay. The previous bull market was from, I think it was 40 to about 60, same sort of gig, right? And what I'm saying there is if you know what you're doing, you get one bull market and you know what you're doing, you're going to make a lot of money because you're going to be the one that says, now I'm going to buy through the recession and I'm going to buy lots because I know it'll be a really good earnings yield and it'll compound at a high rate. If you do the same thing at 2000 or the same thing now, you're probably going to lose money because the good parts, like this chart shows, right? 16.76% per year compound over 15 years. Now, to do that for the next 15 years would be very, very unlikely, right? And it's the same with saying Sydney property is doubling every, 5 years. Well, Perth, right? Perth, since the pandemic, has gone up 78% in 4 years. Well, it's clearly wrong to say, it's going to just keep going up at 20% per year because that means a Perth property will be about $5 million, right? Well, that's not what history shows you. And so if you're aware of that stuff, you're able to say, yeah, things are really awful, it's really terrible, but the earnings yield is 11%. Looking at history, the Cape ratio is single figures. Gosh, that's when you can act in a contrarian manner, buy lots of stocks, right? You're not going to buy it perfectly at the bottom, but you keep feeding money in over 12 months, you end up doing really well. Right, but Buffett came out in November 2008, right, and said, buy American, I am. Right? And the bottom was March 2009. And the old bugger's now, flogging off billions of all the money that he made.
Yeah. Well, most people would say, well, let's just dollar cost average in no matter what the price, even if the yield's terrible.
Yeah, but that's...
most novice investors, I should say.
That's a bad approach in my mind.
Yeah,
it's
why
sort
would
of
you do that
okay, but you'd look at the results. I mean, you just look at the results. And we did it in the coaching call on Thursday night. When you look at the effects of volatility and compounding, the real return is really low, right? Well, how did you get that real return? Dollar cost averaging. Well, don't dollar cost average. Yep. It seems stupid to me that financial advisors or fund managers should basically say, something's really cheap and I'm going to buy lots of it. Okay, cool. That's sensible. But then when it gets really expensive, most of them say, no, you hold for, 20 or 30 years. Well, and talking
contradictory.
Well, yeah. And it's like, okay, well, why did you buy so much then? Because it was really cheap. Okay, well, why don't you sell it now? Oh, no, you compound over the long term. Well,
just keep feeding money in, dollar cost average in.
Yeah, well, that's what I mean. And Buffett, again, in the blog post, Buffett said that when he said, I made a mistake with Coca-Cola. When it was on a PE of 50 or something, I should have sold it. Well, that's why with Apple this time, he's flogged off a lot of Apple because he looks at it and goes, man, I am up a fortune. But he's also learnt from Coke to go, Apple's a great company. Yeah, but I can, I'm going to take off $100 billion of my investment. Right? Why? Because he thinks, well, if Apple falls a lot, he's going to go, oh, man, I really should have rebalanced.
Yeah. Well, if you know market cycles and yield and valuation, why, like in my mind, why would you dollar cost average into something?
Yeah.
When you just wait.
Exactly.
Save your cash, wait until it's a better yield, and then start dollar cost averaging if you need to.
Yeah. There's also there's a really good book out there called Value Averaging. The guy's name Michael Edelsey or something, I can't remember, but it's a really good book. And what he said was, what you do is you know, just briefly, he said, if you said, look, I want 100,000 in 10 years, and I've got $15,000, right? What he said was, he's got a formula that you work backwards from. Right? And basically, when the stock market falls, he says, put in a lot. And when it's gone up a lot, he says, well, don't put in anything. And in fact, you should sell a bit. Right? So this is, again, the idea of saying it's really cheap, buy lots. It's really expensive, sell lots. Right? And it's a really good, it's essentially value investing. But it's formulaic and it's really good. I'll do a presentation on it shortly because it's actually, it's all of these ideas are for people to go, yeah, okay, I like that idea. That rings a bell with me.
Just have a think about it.
Well, and if you set it up systematically, Jacob, it's a lot easier if you say, right, I'm going to rebalance on the first of every month, right? A lot of the problem investors have is not having a systematic process, is not saying, on the first of the month, I look at my stocks and I rebalance, right? And what a lot of people do is they just sort of ignore it. Oh, it's going up. I'll just let it run another month, right? That's not the way you do it. The way you do it is systematically. Because if you've got a process of every time I get an ace, I'm going to bet a bit more money because I know the probability of winning is higher, well, stick to that process, right? And that's the way to do it. That's the way good gamblers make money, is by having a system.
And a systematic process is not having your beta shares app set up to automatically debit $100 a month into an ETF,
exactly.
which I know is something a lot of people do as well. It's like the superannuation effect, to where they money just goes into their super every single month. And they make money that way.
It's just, you've got to be interested in it. But it's like I say, with one good recession, right? If you know what you're doing, bingo.
Ding, ding, ding. What's on Thursday, Tommy?
Thursday, talking about new car sales, down 12.5% just about from the same month last year, which is not a good sign for the economy based on the fact that a lot of people borrow money to finance a new car. A lot of people do it with equity they've built up in their home. And this was one of the leading indicators in the States with the GFC and the housing bubble. So
home equity line of credit.
Not necessarily saying that's what it means, but, it is an interesting data point.
Yeah. There's two big things you borrow for. First one's a house. Second one's usually a car.
Yeah,
right? Hundreds of thousands to buy a house and maybe tens of thousands to buy a car. Right? They're the two big ticket items in life.
No, you've had a good run recently with a new, not a new car, but buying a car at least.
I noticed, going to the dealership, everyone's kind of fallen over you to try and get your business. Like, I made the mistake of entering my details on an ad, and I was getting multiple calls every day. Just dealerships bidding over each other.
Hey, remember last week we were talking about software and Chinese software? Bingo.
Yeah, I think this was
now
more...
you're now getting Sheen ads or Shine ads or whatever they are.
Fell into the funnel, mate.
But that's what I mean. That's what they want. They goddamn want that email address, right? Because then they can get heaps of data and stuff.
Not just the Chinese.
No. But that's what I mean. Everybody.
Yeah, absolutely.
Absolutely.
I'm a lead. But, it was just interesting, right? Way different to when, I last bought a car a couple of years ago. Where they're like,
market,
they're like, this is the price.
Yeah.
Take it or leave it.
Take it or leave it, and we'll deliver it in 6 months and it'll be blue.
Yeah.
Well, there was a book written by Freakonomics. I think it was Freakonomics, which was written a long time ago. And it said the best way to buy a car is you bring 5 dealers and you say, right, Saturday at 12 o'clock, I'm making a decision on which car I'm going to on the car I'm going to buy. It's a Toyota Corolla. It's a 19, whatever model, blah, blah, blah. Here's the specs. You get one shot. Tell me what the price is, right? Don't come back to me and go, I want to, Tom offered 11 grand, Jacob said 11 and a half, and Jacob rings you and goes, I want to renegotiate. It's like, nah, you get one shot at the locker, right? And they say that's the best way to buy a car, right? Because they'll come in with their best offer.
I just had this whirlpool of dealership one goes, what did dealership 2 offer you? Because I'll take 500 off. Then dealership 3 goes, I'll take another 5, and then it's just like, at that point, I was like, I don't want it.
Yeah.
I
don't want any of this.
Yeah.
Like,
then everybody's haranguing you, what about this and what about that and what about this?
Well, I did the same thing. Out front, I was like, look, not in a hurry, but I do need to buy.
Yeah.
Give me your best price.
Yep.
You didn't give me your best price, mate, because you've come back 3 times.
Give
me a
tinted
better
windows,
price.
mate.
Yeah. And I think to me, like you say, I sort of think, well, you're a bit devious because I said I want one price, but you went, I'll come back again. It's like, okay, well, you're not that trustworthy.
What, car salesmen are not trustworthy.
I don't look, you're shocked, right? You're shocked. Righto.
Anyway,
Sorry to any car salesmen out there that obviously are very trustworthy.
Some of you, a lot
course
of
they
you,
are.
most of you are trustworthy.
Yep.
Friday. Aussie trade surplus
Right.
holds.
That's it. You're sacked off the chart,
Oh,
John.
thank you. I've been doing a bad job.
Yeah,
so
I'm gonna
Steve-
do it.
Steve's good at it.
I
think that's your new job, mate.
You just want me to do it.
I do.
What's
Friday, trade surplus. We're in the money, buds. We're in
All
the
right.
money.
So Thursday we were negative, but we've taken the feedback on. We're going to be positive
For
for Friday. Let's end the week well. It's all about a trade surplus. It's continuing. This is going to help the government's budget position. And as you can see, it's been a long time since Australia ran a consistent deficit.
Yep.
What does it mean?
Yeah, Steve?
It means we got more money coming in from trade, which is helping the budget position, right? So if we had a trade deficit, excuse me, that was negative, that wouldn't be real good. But this is helping the government's bottom line because there's lots of royalties and taxes and stuff, right?
So Albo needs to loosen the purse strings.
Well, yeah. But next year is a big year. This year, I think, was, don't hold me to it, was 28 billion. That was the 1.2% of GDP. But the next year, they're stepping it up, and I think it's a bit more than that again. So that will be better,
The next financial
provided
year.
they get elected, in May and then continue on. But I think that's a bit, it's 50-50 at the moment.
It might be good hopefully it'll be good for the stock market. It needs a bit of a boost.
Well, yeah, and again, this is why I say, why is the stock market in the US going gangbusters? Because Biden's spending a lot of money. And where does he spend it? He spends it with companies, right? And they make more profits. And they go, guess what, shareholders? Bingo. That's why I said, as I said last week, government spends money, everybody loves it. The only ones who go off at it are these buffet economists who continue on about, this is all really terrible. It's like, please stop. As if they're going to run out of money. England after the war had a deficit that was enormous, right? But they ran it down over the next 15 or 20 years. No drama, right? The Japanese have had a deficit of 200% of GDP for ages. Well, have they blown up? No. Right? And again, it's these economists with these stupid theories that were for the last century. Right? Then, we print our own currency. Now, you can argue that it's inflationary, all that bullshit. I understand that. But my fundamental point is the government can't run out of money.
But wouldn't our currency lose value compared to other currency? Isn't that the game that they're playing?
But it may be, Tom. See, the argument is, that'll create all this inflation and, they'll have to raise interest rates and all this stuff. Well, I'm sorry, that's not, Japanese inflation is dead, has been dead for 20 years. Budgets have been going, government deficits have been going through the roof. Well, there's no inflation. Interest rates, they're going to go sky high. Well, there's no interest rates going sky high. So again, what they're doing is they're using a theory that was relevant to the gold standard. Right? Now, while I think of it, I've got to do a shout out to Ben.
Yeah.
Because Ben wrote on the socials and went, what we were talking about banking or something.
Oh, this is your nemesis.
Yeah. No. Well, no, Ben said, Australia.
They're friends now.
They're mates now. Yeah.
No, Ben said something about inflation and stuff, and I agreed, but I said, but we don't have a fractional banking system. And he wrote back and went, what are you, an idiot? Of course we do. And I went, well, no, we don't, and argue with the Bank of England. So I sent him a document.
Fighting again.
Yeah, he wrote it back and went, no, here it is in words. And then, I don't know why, I went, nah, blah, blah. Then I looked at it later and I went, actually, hang on. So I went back and read it, and he was right. And so I wrote to him. I don't know whether he's picked it up yet, but I wrote to him and said, yeah, actually, you're right, mate. Sorry about that. I was thinking about the money multiplier. But anyway, that's the mea culpa. But my point,
The
again,
humbleness of Steve Moriarty.
Wow.
well, if you're wrong, aren't you?
But there was an excuse shortly thereafter.
No. Mate, if you're wrong, you're wrong.
I appreciate that.
But
That's the first time
But the
I've
point
heard you
is, the
wrong.
government deficit is, that's why I'm saying in the United States, they're going gangbusters because the government's spending a lot of money. But economists will say, oh, this is unsustainable. How can it be unsustainable if the government creates the currency? Right? It's nonsensical. It may get inflation if they said, right, we're going to give everybody $1 million. Okay, fair enough. But they're not doing that. If you spend it productively, which is what they're doing with the CHIPS Act and the Inflation Reduction Act, right, that creates solid economic growth. Right? So they get paid back in full because they're using the money productively.
Yeah,
Right.
that does make sense.
It's just, as I say, I'm not being nasty, but economists should know better. But they're still using the gold standard as if the government's got to buy gold to counterbalance the deficit. I mean, this is, it's ridiculous. It's like saying,
If that's the
we've
case, gold would be going nuts.
well, and part of the reason why gold is rising is because everybody thinks that, the governments are going into deficit. Oh, that's not very good, It'll
gold.
create inflation and blah, blah, blah. Well, the US has got 6.5% debt GDP. Inflation's falling. Employment figures came out yesterday. The place's unemployment's like 4.1. Wages are rising. Right, they're building all these factories. I mean, you look at it and go, guys, I'm struggling to find out what's really bad here. It's the government deficit. And it's like, mate, the way I'm looking at it, it looks like it's a fantastic thing. Right?
I think you make a fair point.
Thank you,
Stephen.
Jacob.
I think we'll take that.
I think I make a fair point too.
And Ben,
Just
we
don't do-
apologise
Yeah.
on behalf of TMN.
Ben, come back, Ben.
All right, bonus section. Or we've got birth and facility data here, but that must have skipped the bonus section here. I'm having a nightmare. Yeah, that's not there.
Is that it?
Yeah,
Righto,
that's
Dan, you're sacked. Don't come back next week,
Well, this
Dan.
is just on. I mean, there's a 12-minute video here which you can go and check out if you're subscribed to the week that was about cars, just unproductive auto factories over in China. 120 Chinese car manufacturers with 19 expected to be profitable. 120 manufacturers.
Yep. The US in the 1920s, I think, had about 200.
How many of Australia?
Now they got 3. How many in Australia? Yeah, crickets.
Doughy.
But I really recommend you have a look at that because EVs and the car industry, like we were talking about last week, Tom, it creates thousands of jobs, right? It uses the latest technology. We're talking about FSD, full self-driving, the computer chips, AI, all the stuff that cars are doing. They're computers on wheels now, right? Mm-hmm. That's really, really important to keep employment going. Now, China's flooding the market with cheap cars. And so the Germans have said, we're having a real problem, right? Because the factories are only about 50% capacity. And so they're not, they've idled 2 plants. Mm. And yesterday, the EV overnight, Europe came out and said, we're going to put 45% tariffs on Chinese vehicles. The Germans voted against that, right? Mainly because VW are like, well, we manufacture in China, so we want to import the cars. But as I said a few weeks ago, German factory workers are going, yeah, well, I don't give a shit about people in Beijing and Shenzhen, buddy. I want to make a car here.
Yeah.
And so that's the tension you got going on. And we had this, the Germans benefited from this position from about 1990, where they were the ones who were exporting all the Beamers and the Mercedes Benzes. They've been having a wacko time for 35 years. Now the boot's on the other foot. They're going, we don't like this. Well, welcome to the world. That's why I say free trade's, it's over.
Well, the execs at VW have had a good time making the cars cheaper in China and importing them.
Well, yeah, the CEOs are being paid millions. Well, as if they're going to really care about anybody in Brandenburg.
Well, they just care about the shareholders, right? That's really it.
Really? You reckon the CEO cares about the shareholders?
Of course they do, otherwise they don't have a job.
Of course. Oh, yeah, of course.
It's a
That's
KPI,
right.
mate.
Yeah. Yes, that I know. Elon Musk is a good guy. I know they care about the shareholders. I'll bet they do.
All right. One of the 4 Cs that we actually don't talk about too much anymore is demographics or children. And Steve, you've got a birth and fertility data from 2024 here. We're below 1.6, which means it's 50% less new people after 3 generations. So what this means is less people are being born, mainly because people can't afford to have kids.
Well, yeah. Plus, there's a move. There's people move to the cities. They're living in units. Generally, richer countries have less children.
Too busy.
No, it's just in the old days, children were, more children you had. First of all, I'm talking a long time ago, where you'd have 5 and 2 would die, so you'd only have 3. Those 3 would work on the farm. All right, you'd feed them a bit of grain, but they'd pick a ton of grain a week. So I'd be like, well, these kids are really good, so they're productive value. Once we moved to the city, then they became a cost. Right now, I've got to house the little bugger and I've got to school them. Right, and they're costing me a fortune. So, you can't go to Santorini if you got the kids, mate.
Well, if you got 2 people working full time, it's harder to raise kids as well, right? So,
absolutely.
And this is something. Speaking of your man Elon Musk, he talks about this a lot. Of falling birth rates. Yeah.
And
how it's going to impact literally everything.
Doesn't he have 13?
11, does he? 10 kids or something?
He's got a lot, yeah.
Every letter of the alphabet.
Well, he's doing his bit. But look at South Korea. South Korea's birth fertility rate is 0.7. So in other words, in 3 generations, there won't be a South Korea.
Wow. Unless they incentivize having kids.
Yeah, and they're doing that. But I think they've given, I think we mentioned it a few months ago, I think they're giving the equivalent of $10,000 if you have per child or something. Mm-hmm. Like they've got some really, serious. But, a lot of young people these days are just like, yeah, nah, sorry. I'd rather take my job and just go to Europe every year and have my holiday in Santorini, thanks.
Yeah, well, people are getting older. Like people are getting into their 30s really before they go, no, it's time to have kids.
Yeah, well, I had my max at 40. I'd max at 44, and I'd Lola at 49. Jesus,
getting active in your old age.
What was I thinking? Happy birthday, darling. By the way,
Keep you young.
Yeah.
That'll happen.
Yeah. Last night I was at the hospital with my son in a car crash. Keeps you young. I thought, I'm going to throttle him.
A few more grey hairs.
Anyway.
Let's finish on the chow. Tom or Steve?
All right. Many countries hold US assets like bonds and stocks and real estate rather than their own assets. It's enabled them to keep their exchange rates low and exports competitive. And if we look at the chart here, you can see the levels now are reaching the levels. It even looks slightly above what they were in 2000.
Yep.
So people looking elsewhere to invest.
Well, look, we're going to get into this with property because as bizarre as it sounds, it's actually the reason why we've got housing bubbles everywhere. And the reason why is foreign countries, particularly Japan, Germany, China, and a few others, they don't put the money back into their own economy. They buy US assets. And so they buy US government bonds and they buy US government US stocks. Right? Because it helps keep their currency low. And I'll talk about it more in the masterclass. But that's the reason why we've got these global distortions. That's why Donald Trump said, we've had enough of this. because all these countries are going, no, we don't want the American products, but we're going to flood your market with ours. The impact is the Americans either have to increase unemployment or increase debt. That's the only two options they can do. And what we've been doing, and this is in Australia as well, what we've been doing is increasing debt. Right? And where's the money going? It's going into property, right? And that's why we're getting asset bubbles, right? So it's a really really interesting way that it works, and this is why I'm saying it's going to stop, and it's going to be painful for everybody, right? Because those countries can produce way more than the globe needs. And they've all been relying on just shoving their garbage into America and going, the Yanks will buy it, just, EVs, or not necessarily EVs in America, but all the Chinese products, just take them to America, right? China's flogging them off with steel. We've produced all this steel, we don't need it, right, just chuck it in the global market and flog it off it, and that crushes all the steel makers in America and those countries. So that American steel mill would say, okay, well, we're going to have to stop and we're going to sack all the workers. So the Americans are saying, well, we can't do that. We can't just have this huge unemployment. So the only alternative is to encourage debt. And instead of the government saying, all right, well, listen, we'll build a road and we'll use all those blokes who are at the steel mill, because they don't want government deficit, thanks economists, it's been cheap interest rates with people allowed to borrow lots of money. So what have they done? Borrowed money and bought property, right? But it's a really serious issue. But what I'm pointing out here, Tom, is also the idea of there's a lot of, if panic sets in, there'll be a lot of foreign countries that sell down US assets. So the stock market might,
taper off.
Might go down a bit, because countries will say, listen, we'll dump all those NVIDIA stocks that we've got, dump all the US assets, right? And that's how that's how you get the bubble, and then the bursting.
Yeah.
Right?
Then the margin calls, then the panic selling.
Exactly. Is that it?
That's fascinating. Thanks, chaps.
Absolutely.
We're done.
Excellent,
All right.
gentlemen.
Thanks, everyone. We'll see you next week.
See you next week.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.